Hi, thanks for tuning in to Talk ETFs. My name's Sumit Roy, and I'm Senior Analyst here at ETF.com. One theme that I keep hearing about over and over again is infrastructure. Improving the country's infrastructure is seemingly something that everyone wants. It's a bipartisan issue. A little over a year ago, President Biden signed a $1 trillion infrastructure bill into law. Yet there's people calling for even more spending. So is there an opportunity in this space? Well, I got the perfect guest to help answer that question. Jay Hatfield is the CEO of Infrastructure Capital Advisors, an ETF issuer focused on this space. Jay, welcome to the show.
Thanks, Sumit, for having us on. It's fun.
Jay, what's the state of infrastructure in the U.S. today? Year after year, we hear about how U.S. infrastructure is in bad shape and how we need to spend billions of dollars to get it into shape. What's your take?
I think that a lot of the notion that we have this terrible infrastructure was more of a political talking point than reality. And I do not believe, even though it's a good investment, but I don't think infrastructure per se is that critical to economic growth. Obviously, you need adequate infrastructure, but everybody always would talk about, our airports, they're terrible. Well, I travel a lot. We have a lot of brand new airports. Admittedly, they're not as good as Europe, but that's partly because of their tax situation. They have all that retail there. So I think that the infrastructure is adequate. If people disagree with me, it's getting better because of that gigantic bill. So I think it's going in the right direction. And from what I observe, it's completely adequate to support economic activity in the United States.
I want to turn to one of your ETFs now, AMZA. It's an ETF that focuses on energy infrastructure, and specifically, it invests in master limited partnerships, or MLPs. Can you explain what MLPs are?
MLPs are pass-through entities that, they don't have to pay corporate tax. And so, since they don't have to pay corporate tax, you get more of the distribution, and you can usually defer that. And AMZA, the good thing about AMZA is it structures a corporation, and so therefore, you don't get a K1. If you own it, you get a diversified portfolio with a K1, and it happens to have about $17 of deferred tax assets, so that we don't have to accrue for taxes at the corporation, which could be a disadvantage. So it's an excellent way to hold MLPs. If you don't want to get a K1, get a good diversified portfolio. We do write covered calls. It's active, so we're constantly monitoring the weights and adjusting the weights appropriately.
Now, Jay, MLPs were very popular for many years because they were kind of seen as toll booth operators. It didn't really matter what happened to oil and natural gas prices because you always needed to ship and store those commodities. So presumably MLPs would always benefit. Yet if you look at the performance of MLPs over the past several years, it's been kind of disappointing. Why is that the case? And do you expect that to change going forward?
I would divide it into kind of two periods. So there's been the last, call it 2 years, where they've performed extremely well. Well, since the pandemic, they've performed ridiculously well. But prior to the pandemic, a little bit before the pandemic, they were repairing themselves. So they were transitioning, like all energy companies, they were transitioning from being growth companies to being value companies, value and dividend companies. So, but to do that, you need to slow down growth, reduce leverage, increase dividend coverage so you have free cash flow, you can buy back shares. So the notion that they were growth companies came to a screeching halt when oil crashed in 2015. Took about 3 or 4 years for them to become more what they are today, which is very high quality, national, diversified companies that have the right characteristics that you should look for dividends. Because you want dividend growth, but for dividend growth, you need to have retained earnings. Because you don't want to, after 2015, before they restructured, these companies were dependent on the capital markets, and the hedge funds would attack them and say, well, you have to issue equity. So, we're going to short your stock, and then it's more diluted. But now they can't do that because they're buying back stock and they're funding whatever capital they need internally. So they've repaired themselves. So it was kind of 3 horrible years, and then they've been getting steadily better. And they're now a pretty stable asset class. They're not nearly as volatile as energy stocks as a whole. And so they're much more appropriate for income investors now.
Jay, it's been an absolute pleasure. Thanks so much for taking the time and sharing your insights with us.
Thanks, Sumit, for all the questions. I appreciate being on.